The real estate, the defaults are picking up. Real estate has topped. It's on the verge of a very big breakdown. So that's kind of like how I look at the markets from a really high level. So I believe we're coming into chaos. So eventually we've hopefully, we've all been through probably a bear market of some sort, and eventually another one of these is going to come around. It's going to happen in the precious metal space. It's going to happen in the equities and real estate, all of that stuff. The big thing is you need to be able to identify when one is starting. You also need to identify when one is coming to an end and when you want to get into the markets and take advantage of the price going up in value.
The U.S. economy is presenting a complex picture, with a slight rise in inflation coinciding with a slowdown in job growth. This mix of signals has left many people uncertain about the implications for their finances and the broader economic outlook. In response to these uncertainties, the stock market has shown notable movement. Following the recent election, the market experienced a boost, particularly in the tech sector. The Nasdaq Composite climbed by 0.8%, and the S&P 500 rose by 0.4%. Amazon's strong earnings report played a significant role in driving investor optimism, leading to a sharp increase in its stock price. Chris Vermeulen from thetechnicaltraders.com offers in-depth chart analysis, focusing on money flows and technical indicators to track market trends. He emphasizes the importance of recognizing market cycles, particularly identifying the start and end of bear markets. This ability to detect shifts is crucial for making well-timed decisions about when to enter or exit the market, enabling investors to capitalize on price movements. Historically, a Republican clean sweep has been favorable for the S&P 500, delivering average returns of 16%. Sectors that tend to benefit most include fossil fuel energy, financial services, and smaller cap companies, which thrive in a business-friendly regulatory environment. Vermeulen likens the stock market's behavior to ocean waves, where patterns emerge in sets. He compares investors to surfers, waiting for the right wave to ride. These market waves allow investors to seize opportunities during upward trends or avoid losses during downturns. For more insights, watch the full video and don't forget to like and subscribe to stay informed about the latest market updates.
I don't get into news. I don't get into policies. I don't really worry about what the Fed is going to do, because what I follow, the real indication of which way price is going, is to actually follow price itself. And so what I do is I look at the charts, the money flows, cycles, and things like that, which I'm going to show you. And then we can identify, which assets are strong, how different assets are moving, how they relate to each other. So I'm going to share my screen and show you guys a little bit of how I view the markets and how the markets kind of unfold over time here. And once you see this technical side of the markets, if you're not a technical analyst, this might crack your brain open and you might actually see a whole new way to view the markets. If not, hopefully you'll pick up something on this, because there's some very interesting things unfolding right now. So eventually we've hopefully, we've all been through probably a bear market of some sort, and eventually another one of these is going to come around. It's going to happen in the precious metal space. It's going to happen in the equities and real estate, all of that stuff. The big thing is you need to be able to identify when one is starting. You also need to identify when one is coming to an end and when you want to get into the markets and take advantage of the price going up in value. And so there's a few really simple ways, a high level view of how I look at the markets. And I want to cover how we go about doing this, because once you have this feel or this vision or view of the market, everything really changes in my opinion. And it comes down to market structure. Now, I live on the water. I'm a boater. I'm a sailor, kiteboarder, all of that stuff. I'm a surfer. And so I like to look at the stock market, and not just the stock market, but this is the same with gold and silver, precious metals, pretty much any asset class. But look at the stock market as the ocean tide. When the tide goes up, it lifts all boats. When the tide goes down, all boats go down. And so that, if we were to look at the stock market itself, we want to know, are we in a bullish environment? Now, this is the SP 500. This is the weekly chart going back to 2020, the COVID low here. And so if you look at the stock market or whatever asset it is, are we in a bullish, long-term rising tide environment, or are we in a declining, falling tide? Now, if you're in a rising tide, you obviously want to own that asset class, which are equities in this case. If it's falling, you don't want to be. You might want to be somewhere else. You might want to be in gold. You might want to be in the US dollar, rallied 18% in 2022 while the stock market fell. So you want to move away from a tide that's going down and into a rising tide. And right now we are back into a rising tide environment. So that's the big view, bull market or bear market. If we were to zoom into a smaller time frame, like the daily chart of the SP 500, the stock market has these wave-like patterns that happen over and over again. And think of yourself walking down a beach with an ocean there, and you see surfers out floating past the break. They're sitting on their boards waiting. What are they waiting for? They're waiting for a set of waves to roll in. And the stock market has a set of waves that roll through. Usually there's about 5 to 12 waves that roll through various assets, stocks, gold, silver, various assets like that. And we can identify those big waves coming. And when they're coming, we can position ourselves. The nice thing about identifying and hopping on these strong waves is we also know when they're starting to get weak and when we need to carve off before it swallows you and takes you down with it. And so in a rising tide environment, waves are usually stretched to the upside because the markets naturally always want to go higher. The pullbacks are short-lived and you go back into another rally phase. In a falling market environment, which I think we'll be coming into sooner than later, it's usually more abrupt and the waves are to the downside. And you want to make sure you take advantage of falling pricing and know that there's very limited upside potential when the market does rally. And so once you can identify these waves and find a way to navigate these, then the market kind of really becomes a great opportunity.
The jobs report, released just days before the presidential election, ignited significant debate on the campaign trail. Supporters of Vice President Kamala Harris dismissed the disappointing job numbers as noisy, while Trump's team used them to emphasize the economic struggles under Biden's presidency. This clash highlights the broader tensions surrounding economic policy and its impacts as the election draws near. As of October 2024, the unemployment rate stood at 4.1%, up from 3.8% a year earlier. Teen unemployment was especially high at 13.8%, with unemployment rates for Black Americans at 5.7% and Hispanics at 5.1%. Chris Vermeulen notes that job revisions and layoffs in sectors like manufacturing often act as early indicators of broader economic shifts, typically foreshadowing changes by 1 or 2 quarters. Adding to the financial stress, over 30% of credit cards are now maxed out, signaling rising defaults and growing economic strain. Both commercial and residential real estate markets are also under pressure, with delinquencies increasing and home sales slowing. Let's now shift focus to a related video for deeper insights.
This is a little bit outdated, but overall, when we look at the job revisions of jobs getting cut, manufacturing is like 1 to 2 quarters ahead of the economy. Businesses slow down, they don't put in their orders, and usually put orders in like a quarter or 2 before. And so manufacturers are already laying off jobs. That's telling us there's going to be some weakness in the next 4-6 months or so. And we're starting to see that. Retail trade, we're starting to see layoffs there. Leisure and hospitality, a bunch of layoffs. People are starting to tighten their wallets. People aren't traveling quite as much. There's still lots of demand out there, but it's just not the same. And of course, businesses, I was just in Las Vegas with about 36 very successful entrepreneurs and businesses, and they're all saying the same thing. The market has completely changed. Wallets are closing and tightening. Businesses is slowing, and everybody is cutting they're cutting all their expenses for their businesses. And so all these professional services are laying off people because businesses are trying to tighten up and do all that. And with this happening, we start to see unemployment start to rise. These red lines here is when the unemployment crosses the 24-month moving average. And every time we've crossed it, we've gone into some type of financial reset and some type of financial crisis. And so we've seen that. So now we're just waiting for the music to come to an end. If we take a look at depleted excess savings in the United States, so this is just before COVID, there was a lot of savings, and now we've fallen down. People have burnt through their savings, and inflation is huge. And now that they've burnt through their savings, we're starting to see delinquencies come up in credit cards. If we look at credit cards, we have over 30% are maxed out credit cards, and they're completely maxed out. And so that's the first place people start to default. They don't default on their mortgages first, they default on their credit cards. And we're seeing the largest number of maxed out credit cards. Usually credit cards default, but people don't generally max them out and then default. They just I can't afford what's on there. But people are maxing them out and then defaulting on them. And then on top of that, we're starting to see delinquencies in commercial real estate, which has already been on fire for a while, starting to skyrocket. And we're seeing residential defaulting as well. And then just to take it one notch further here, if we look at the cost to buy a house, this is going way back to the early 70s, 60s, how the cost of a house, it has just skyrocketed. It is nosebleed territory. Most people can't afford a new house, young individuals. It's too expensive. We're seeing housing start to roll over. This is housing starts. I know this is a lot for people to process. This is really high level, guys. You don't need to totally understand what I'm talking about, but home starts are slowing just like they did a year or so before the housing collapse in 2008. We're seeing the same thing now. And right now we are seeing, in terms of existing home sales, they're just very dormant. There aren't really any sales going on. In my town, there was about 60 to 80 homes for sale like 2 years ago, and it was impossible to get a house. It was a bidding war. Houses were sold. And now there's 600 homes in my town for sale, which is unbelievable. And the crazy part is nothing is selling. And if we look at the price of homes, everybody still wants to get this top dollar, but nobody wants to lower their price. And because they're all wanting to top dollar for the house, they're not selling. And so the only way we're going to start to see home sales pick up is when the price starts to fall and people start to be like, I need to get out of this house. And we're going to see the housing market unwind. It's going to be kind of the start of a painful process. So there's this huge technical wave going through the markets in terms of where money's starting to flow between different asset classes. Gold is a big warning sign. The real estate, the defaults are picking up. Real estate has topped. It's on the verge of a very big breakdown. So that's kind of like how I look at the markets from a really high level. So I believe we're coming into chaos.
The current economic landscape presents a delicate balance for U.S. markets, with investors closely monitoring potential shifts in Federal Reserve policy. A stable job market and easing inflation suggest that the Fed may delay tightening measures. However, any rate cut will depend on upcoming economic data. The Fed's cautious approach to interest rates, amid cooling inflation and steady employment, has broader implications that extend beyond U.S. borders. What's next for the U.S. economy? Share your thoughts in the comments below. If you found this video helpful, please give it a thumbs up and subscribe to stay updated with our latest content. We appreciate your support.